Hi everyone, I'm Yuki. Today we are going to understand what a crypto ETF actually is, not through words or text, but through diagrams and animations, starting from zero. You probably heard of a Bitcoin ETF, but what's actually happening inside it is usually a black box. Here is a trick. Once you think of it as the invention of wrapping paper, the whole thing suddenly clicks. The site is available in 4 languages: Japanese, English, Spanish, and Portuguese, with 9 interactive demos in total. Today, we go through the tabs at the top one by one and actually play with them together. One quick note before we start. This is not investment advice or association. It's purely an educational tool for understanding how the machinery works. Alright, then let's dive in. First up, what is an ETF? In one word, it's a box. Watch the animation here. A whole Bitcoin is too expensive for most people to touch, so you put it in a box, slice it into tiny shares, and place it on the exchange shelf. Now you can buy and sell it from a regular brokerage account for a few dozen dollars a share, exactly like a stock. That's what an ETF really is. Fill a box, slice it, list it. Just remember those 3 steps. How is holding Bitcoin yourself different from holding it via an ETF? Tap here to compare. Tap Keys. Hold it yourself, and if you lose your private key, it's gone forever. With an ETF, a professional custodian holds the keys for you. But look at withdrawal. Hold it yourself and you can send real Bitcoin anywhere. With an ETF, you only hold a claim. You can't withdraw the actual Bitcoin inside. There are trade-offs both ways. By the way, every tab on this site has an honesty point. Here it notes that these US spot funds are legally speaking not ETFs but ETPs. I buried in these little bits of honesty throughout. This next one is the heart of today's video. What actually happens inside the box? The keyword is special ordering a popular item. Your local shop runs out of a hot product, so they order more from the wholesaler. The exact same thing happens inside an ETF. There are 5 characters. You, the investor, the exchange where shares sit, and the star of the show, the restock buyer. Only the buyer has the special power to open and close the box. Then let's actually run it. Watch the 2 numbers at the top. The green line is the contents value and the black marker is the price tag. Step 0. Normally, investors just trade among themselves. The 2 numbers match at $50. Then, demand surges. And only the price tag rises to 51. The contents are still worth 50. That's a $1 premium. Then, the buyer sees this and moves. Shares I can buy from $50 of material are selling for 51. That profit is the only reason the buyer acts. Then, first, the buyer checks the recipe the fund publishes daily. 1 unit equals 10,000 shares equals exactly 5 Bitcoin. And this is just an example. Then, with their own cash, the buyer buys 5 Bitcoin on the market. Their hand changes from cash to 5 BTC. Then, they deposit it with the vault keeper, and the board balances rises from 100 to 105 Bitcoin. And the board keeper sends a confirmation to the issuer for Bitcoin safely stored. Without this confirmation, not a single shares can be created. And once confirmed, the issuer creates 10,000 brand new shares. Shares outstanding go from 200,000 to 210,000. And the buyer sells those 10,000 shares on the shelf. With more supply, the price tag eases from 51 back to 50. And the buyer pockets the difference as profit. A common question: if the price tag comes back down, did the person who bought on 51 lose money? The answer is yes. They overpaid by exactly $1. But this adjustment happens automatically in seconds to minutes, so real gaps rarely grow beyond a fraction of a percent. And the contents value itself was never touched at all. When selling surges and the tag drops instead, it's this in reverse. The buyer scoops up the cheap shares and returns them to the box, and the tag climbs back. Restock and return, that's the beating heart of an ETF. This step makes that mechanism even more intuitive. Picture the price tag tied to the contents by an invisible rubber band. Pull the price tag with the slider and see that? The rubber band goes taut and turns red. That's the premium state. And when you let go, it snaps right back to $50. See the buyer down here reacting with restock triggered. Those steps from tab 2 are the rubber band. Now let's cut the band. Check GBTC mode. This is a true story. Before it became an ETF, a product called GBTC had no return counter, no rubber band. So when the price drifted, it didn't come back. It sat at a deep discount for years. Really shows you how important that band is. Earlier, the buyer deposited Bitcoin, but there are actually two ways to do that. Let's listen. The bottom lane is in kind. The buyer deposits their own Bitcoin directly, straight to the finish. The top lane is cash. The buyer hands over cash and the box has to go buy Bitcoin on the market. A detour, and along the way, costs drip out. Trading fees, price slippage. And those costs are paid from inside the box, which means all the investors bear them. When the US launched in early 2024, it only allowed the cash method. In-kind wasn't permitted until July 2025. And here's the thing, Hong Kong used in-kind from day one, back in 2024. Now the regulatory side. Who has to say yes before this box reaches the shelf? In the US, the gatekeeper is the SEC, the Securities and Exchange Commission. It used to take a yes on two documents. The first, from the exchange, you want to share this. The second, from the issuer, the product's contents label. Both are needed before it can list. But in September 2025, the rules changed and it effectively became just one document. The old route could take up to 240 days. The new route erased that whole lane. That's why we are seeing so many new ETFs launched right now. This is my personal favorite part. Getting a spot Bitcoin ETF approved in the US actually took 10.5 years. Let's watch that fight in 6 acts. There are 2 gates on stage. On the left, the spot ETF gate, but it's blocked by a blue shield. The shield reasoning is Bitcoin isn't connected to a camera-equipped market that watches for fraud. And 2013, the first filing. It bounces off the shield and no answer comes for nearly 4 years. And next, 2017, finally a denial. And by 2022, at least 7 piled up on the floor, all rejected for the exact same reason. But here is a twist. In 2021, the CC opens the other gate, the futures gate, and lets a future ETF BITO through. The CME future market has cameras, they say, but what are those cameras watching? Bitcoin's own price. The first crack appears in the shield. And next, 2022, the grayscale gets denied. They sue within hours. The argument, the same cameras can watch the spot market too. And next, 2023, the court rules yes to futures, no to spot, with no explanation, when both rest on the same market, arbitrary and capricious. The seal shatters. And in January 2024, the spot gate finally opens. 11 ETFs approved at once, trading the next day. The resolution of a 10.5-year fight. The idea that the US was first, actually not true. The world's first spot Bitcoin ETF was actually Canada's in 2021. 3 full years before the US, and Hong Kong had the world's first spot Ethereum ETF, and supported in kind from day one, more than a year before the US allowed it. And Brazil and Australia have spot ETFs too. The baton of trust keeps getting passed from country to country, and it's still happening right now. The last tab is a 13-year timeline. Everything we covered today laid out on one axis in 5 chapters. So there you have it. Crypto ETFs understood through 4 keywords: wrapping paper, the box, the rubber band, and the 2 gates. I'll put a link to this site in the description. If you enjoyed this, a like and a subscribe would mean a lot. See you next time. Bye.